Hi, and welcome to the Fixed Income Securities Defining Elements chapter. So, we are starting with this the fixed income, and fixed income is not easy for anybody to grab. It takes a while, but if you bear with me and we'll make it through. So, let's get started. So in this chapter, so basically it's mostly defined the what are the features of the fixed income securities and what's it's the uh, indentures, what's covered in the indentures basically, and some simple example how the cash flow of the fixed income security or specifically the bond uh, is calculated. So that's not a very tough reading, but this is one of the building blocks which help you further in next readings as well. So let's get started. So when we say the what's the features of the fixed income securities, we mean the bond, because bond has the fixed coupon rate or fixed interest. So think from if you buy the bond from the even from the investor perspective, right? Then what are the things you are looking for, and also who issues this? Who are the so first thing we look, okay, who are the issuers of let's say this bond. So in this reading or the subsequent reading, whenever I mention the fixed income, we meant as a bond. So let me grab my pen. Yeah. Okay. So there can be many issuer to the fixed income securities. For example, just give me a minute. Yeah. So we were saying that there can be a many uh, issuer to the fixed income security or a bond, right? So the issuer can be, so these are the issuers as classified in this rating. So it can be super national organization, sovereign, non-sovereign, quasi corporate, and special legal entities. So when we so think this way, when we say the supranational, it's more like a World Bank, right? World Bank. Sovereign is nothing but our national level. For example, Canada, US, these level, right? India or any country. Non-sovereign means these are even. So we are going think this way. We are going from the very high level that this can be many government who's funding to the World Bank, and then World Bank, as an entity, is not related to one country. So then we go to the country level, and then we go to, for example, city of Toronto is in Canada, or city of Edmonton is in Canada, right? So, for example, city of Toronto, it want to do something, and then, or city of Canada, or we can say the state of Minnesota in USA, right? State of Minnesota in USA, and this is Canada, right? So Canada, they issue some bonds because they need to raise some money. And then the quasi is can be, you can think of like a government owned or agencies, for example postal services, right? Like in Canada, at least I know, is government owned, and also in many countries I think is common, or railways it can be. And then this is the heavy chunk here, which is the corporate. These are not government owned, so it can be insurance or banks. For example, banks or insurance, right? So these are the traditional level. SPC is like there is a separate reading on SPC, like or say I say there is a separate reading of asset-backed security. So this is a whole very big world of securitization as well. So what happened in this? They also issue this. So basically, for example, bank do the loan, issue the loan mortgages to the people, and rather than keeping the loan, it's in loan book, which is it's sell its loan to these SPEs, or it can also called SPE or special legal entities, a couple of names in the market, and then they issue a bond afterward it. So think from that, and we'll cover in very detail in the introduction to the asset management, I think that asset backed security, that chapter name in very detail. But SPC, special legal entity, is nothing but think from this chapter preview that this is one of the another kind of a issuer as well. Okay, so this is one dimension of the bond feature, is who is the issuer of the bond. The next is the maturity, right? My bond can be mature, for example, from 1 year to 30 year, or century bonds maybe 100 years or longer, right? Depend upon the maturities. But in the book, if it's mentioned, if the bond is maturing less than 1 year, right, is less than 1 year, then this is the money market securities, which means is very liquid money market securities. But if it's over 1 year, so 1 year is a cap dimension. If it's greater than 1 year, then it's called capital market. Capital market. The next is thing is the par value, right? What's the amount uh, of the issuing? What's the total principal amount of this bond? So it can be uh, the par value or the principal value. So the amount the issuer agreed to pay to the bond holder when the bonds mature, right? So this is the total amount. This is not like a individual investor amount. So if the issuer wants to raise, for example, 10 million money, like let's say any bank wants to raise a $10 million, right? At, and in return of this 10 million, so let's say the bank is agree to pay 6% coupon, or in coupon payments or interest payment. So this amount, and this is raised for, let's say, they will return in, it's not a money market, so let's say in 5 years, right? So in 5 years they're saying, okay, bank says I can return shortcut of years, so in 5 years I'll return. So this 5 year basically is nothing but this is the principal amount. The coupon, which, or the interest payment, which bank is saying, this is this one, the coupon rate, right? And 5 year is nothing. The third case is nothing but this is maturity, right? So the coupon rate, one flexibility here is it can be fixed like this, or it can be a floating rate, right? So floating rate means it's variable, like every uh, coupon frequency, coup- it's we can set it. So what is coupon frequency? Coupon frequency is how often uh, the issuer of the bond they are planning to pay. Are they planning to pay annually, like once every year, or semi-annually, quarterly, or even they can do monthly, right, every month? And the currency is nothing in which the bond is issued. So the bond is issued in the, for example, if it's the US bank, like the, or any other corporation, like if it's Apple stock, for example, one corporation, that's, we know, very famous company, it's in US, so they may want to raise in the local market, which it can be then US dollars, right? And now if just want to put some one more bullet point or thought here on the floating rate, Now we know this is how often it get paid. In fixed rate, the coupon raise the same. For example, if it's 6 is 6, is 5 is 5. But on floating rate, the coupon rate, for example, depend upon some benchmark, like mostly it's the LIBOR rate, right? So that's the London interbank offer rate, I think it's what it's called. So, or any other reference rate, right? So let's say if uh, that reference rate, let's say, is 25 or 2%, right? Let's say 2%, right? And today's rate is 2%. Usually the convention is, okay, let's make simple. So yeah, 2% plus LIBOR, right? LIBOR rate. So this is mostly the convention in the market. So there is some fixed rate plus some LIBOR rate in the market, right? So if the LIBOR is, let's say, 1%, then my floating rate is 3%. Nothing much fancier here. If my LIBOR rates goes up, let's say to 1% to 5%, then this gets set to how much? This gets set to 2 plus 5, which is equal to 7%. Don't worry, we'll do one more example for this one in later. Okay, so okay, the next important uh, topic here is the yield, right? So yield in this book, it can be like a current yield. Current yield is nothing. If you have already read the or studied the equity section, there you notice that there is a dividend yield on a common share, right? What's the dividend you are getting on a common share? Similarly, in the bond world, it's called the bond annual coupon. When the coupon, which we know is the interest rate divided by the market price, so that's the dividend yield. For example, if we have a 6% coupon and coupon and its par value is $1,000, right? And the market price in the market, its bond is trading as $1,010, right? Then we so the one thing to note here is it takes the market price, not the par value. So the 6% of, but the coupon, we know it's always calculated. We do the one example later, but I just want to highlight this, the current yield, quickly. uh, how the coupon is calculated. So coupon is calculated based on this $1,000. So this one will go 6. So we'll get, if it's annual, so we'll get 6% of $1,000 is $60, right? Divide by the market price of 1,010, which comes up to the 5.94%. So because of the market price goes up, so this the yield is here is you see is not 6% we are actually getting, we are getting 5.94%. Okay, so that's just the small topic here. Okay, this is the yield to maturity. What is yield to maturity? You, or this can be in the short form as YTM, you heard a lot. So it's nothing but it's the discount rate, right? It's discount rate that equates the present value of the bond future cash flow until uh, the maturity to its price, or is the market expectations of the bond return, right? So what's the expectation? So basically it's, you can say these are the discount rate, or what's the is very simply written here, what's the expectation of the market to this bond. So if you hold this bond, especially until the maturity, if the bond is whatever the maturity of the bond is, either 10-year or 5-year or 30-year, if you keep the bond, what's the uh, yield to maturity then, right? So that's what it's about. Okay, now let's take one example of the cash flow of the bond. Okay, so when we say the plain vanilla the bond cash flow, this means it doesn't have any features of, for example, call, put, or any other features. We will learn in this reading on those provisions of the feature, but think simply like a bond. For example, okay, let's take this one. If the bond is a 2-year government bond with a 6% coupon and the par value of 1 million, right? So what's the cash flow of this bond? Mostly the US bond pays, even if it's not written here, we know once it's the US bond, we know the coupon payment is semi-annually, right? Every 6 months. This mean if it's semi-annually, this mean if, and this is always state as the annual rate, which is the 6%, then since semi-annually is 3%. Okay, so this is my 3% rate. So this is my timeline going on. So what's happening here? So this is from t 0, 0.5 is 6 month, right? 1 year, 1.5 years, so 1 year and 6 month and 2 years, right? So this is happening. So what happened? So this is 2 years, right? So we have four, 1, 2, 3, 4 interval from 6 months onward. Zero means what investor? So think from the investor perspective. So if investor is interested in this one, so first investor will take the give this money, right? So that's why there is a huge negative 1 million cash outflow here. You see, this is negative. So this is outflow from investor perspective, right? From investor perspective. Okay. Then every 6 months, because of this semi-annually, it investor will receive the cash flow 3%. So 3% of 30,000 is nothing but 3% of 1 million, right? 1 million, which is 30,000 every 6 months, every 1 year, 1.5 year, and then 2 year as well. 2 year there is a large chunk, because at maturity, this is at maturity, right? Maturity, the investor receive the coupon payment plus is par value or principal amount back, right? Back. So because this is maturity, so that's why this is a huge spike here as well. Okay, so this is the example of the fixed one. The floating rate is pretty much the same, except the floating rate is how the coupon reset, uh, and then once the coupon is reset, then the cash flow is pretty straightforward. Okay, the floating rate, let's take how the coupon is reset with this example. This is taken from the book. There is one of the examples provided there. So floating rate the is also called the floating rate note, FRN, right? So for example, in this example, the coupon frequency is make a payment in June, and there is a, so it's a semi-annual, right? So there is a coupon payment in June and in December, and the coupon rate, how it's set, as is a LIBOR, which is a reference rate plus 25th basis point. So basis point is what? So 1% is equal to 100 bips, right? So 25 bips is what is, so this is 0.25%. So this is what the convention is. Mostly in the fixed income market, usually we refer to as a bips. So and also given at t, at times now t at 0, the 6 month LIBOR at the end of June will be so end of June will be 3%, and end of December it will be higher. So the LIBOR rate, so if this is the LIBOR, so for example this is 3%, and then this is 3.5%. So in June and in December, right? So this is the LIBOR interest rate. So June is here and December is here. So think this is going up. So the interest rate is going up. Okay. So now the question is, what is the interest rate applied to the payment in due in December, right? So if my uh, if I am here right now, what is my interest rate in December? So can you guess what it will be? Okay, so the interest rate applied to the end of December will be the interest rate of, so this is my coupon. So this means the LIBOR plus 25, as we know, is 0.25 bips. So this is the question. We need to know what's the coupon. So what is this? So this will be either this one or this one. So this won't be this one. So the interest rate applied is, we take this one, 3%. So 3% plus the 25, because it's set prior, uh, that what it will be the interest or the coupon paid after 6 months. So plus 0.25 percentage, which will be 3.25 percentage. So this mean my answer is this one. Okay, so I'll end this video here. So in this video we covered the floating rate example, how this is set. Then we saw the cash flows of the plain vanilla bonds as well. We see what's the my yield to maturity. Basically it's just the discount rates or the market expectations uh, going on, and then view some of the features of the bond, which is the pretty much the basic and the important features, which is the issuers, maturity, principal, coupon rate, currencies, and the coupon frequency as well. So thanks for staying with me, and see you soon in another video. Thanks. Bye.